Imagine a world where artificial intelligence is everywhere, driving unprecedented growth, a technological revolution promising to reorganize civilization itself. But what if the infrastructure supporting this vision is built on sand? The current AI boom feels unstoppable, yet the whispers of an impending economic bubble are getting louder. This time, we are going to expose the hidden vulnerabilities in this supposed tech revolution and reveal whether your investments are truly secure or if we are on the brink of another historical collapse. This is the AI gold rush, and financial history is already writing the ending.
The modern financial market is driven by a single narrative: the exponential, limitless potential of artificial intelligence. We are witnessing an investment frenzy on a scale not seen since the dot-com era. Major technology corporations are pouring unimaginable capital into this pursuit. Amazon, Microsoft, Alphabet, and Meta collectively spend over $97 billion on AI infrastructure in just the third quarter of 2024 alone. Microsoft, driven by the race for AI dominance, is planning an astronomical $80 billion investment in data centers in 2025. This monumental expenditure has led experts to label the current surge a $320 billion bubble. Yet the anxiety underneath this euphoria is palpable. The fear that these heavy investments will not deliver immediate, quantifiable revenue is already causing market tremors. When Meta revealed plans to ramp up AI spending, its stock plunged by 11.8%. Microsoft shares slipped 3.5% after reporting record capital outlays. The market is questioning the fundamental arithmetic. This massive speculative boom shares cautionary hallmarks with the dot-com bubble of the early 2000s. Then, as now, companies with no profits were valued at billions simply for having the right label. OpenAI's CEO, Sam Altman, himself conceded that the current excitement surrounding AI is overexcited. He warned that the sector could face a correction similar to the dot-com bust of the 1990s. History doesn't repeat exactly, but it rhymes, and the melody of the AI market echoes 1999 perfectly. The disconnect between valuation and reality is staggering. A report by the Financial Times noted that 10 loss-making artificial intelligence startups have seen their combined valuations soar to nearly $1 trillion. These firms, including giants like OpenAI, are burning cash heavily, with subscriber numbers and revenues far short of what their valuations imply. Some venture capitalists are cheering this mania on, arguing that bubbles are good because they attract talent and investment that eventually build lasting industries. But the ordinary investor must remember the lesson of history. Innovation is the spark, but liquidity and greed are the fuel that leads to collapse. The most rational mind can be blinded by the glow of easy riches. Even Sir Isaac Newton, the genius who unlocked the laws of motion, lost a fortune in the South Sea bubble of 1720, driven by the belief that he was missing out on greater gains. His famous admission echoes across the centuries to our current AI mania. I can calculate the motions of heavenly bodies, but not the madness of men. Intelligence is no shield against mass delusion.
Every historic bubble, from 1929 stocks to 2008 housing, is underpinned by easy money and staggering amounts of debt. The AI gold rush is no exception. In fact, it is setting new records for precarious financial leverage. The immense capital expenditure needed for AI, primarily the construction of vast, energy-hungry data centers, is being funded through complex and highly risky financial engineering. Wall Street is developing new ways to get it for them, writing big checks for now and creating complicated deals whose performance is uncertain once the frenzy calms down. Banks and fund managers are leveraging their money by arranging debt in multiple tranches and positions, packaging these high-risk loans and selling them to pension funds and retail investors as an opportunity they don't want to miss out on. This looks strikingly similar to the layering of paper upon paper, mortgage-backed securities and derivatives that defined the 2008 financial crisis. The sheer debt load is alarming. Bank of America analysts warned that major tech companies are increasingly using debt to finance data centers. This spending is projected to consume nearly 94% of their free cash flow in 2025, a sharp increase from 76% in 2024. When leverage meets euphoria, the result is self-reinforcing insanity disguised as prosperity. Adding to this instability is a system critics are calling circular financing. OpenAI, NVIDIA, Oracle, and others are engaged in an incestuous relationship where they act as each other's customers and investors. OpenAI invests in companies like Oracle using money they do not possess, and Oracle builds data centers and buys chips from NVIDIA, who in turn invests back into OpenAI, ensuring future chip purchases. This is a closed, unsustainable loop. OpenAI itself is reportedly burning through cash and owes a staggering $1.4 trillion in future obligations. Some observers, including Michael Burry, have even called the accounting practices surrounding this infrastructure spending a common fraud of the modern era. By artificially extending the useful lifespan of chips and computing equipment, which often require upgrades on a 2 to 3 year product cycle, companies can artificially boost their earnings, obscuring the full cost of this massive infrastructure build-out. This illusion allows companies to appear stable even as the debt mountain grows higher.
In the historical gold rushes of the 19th century, the vast majority of prospectors went broke. The people who made fortunes were those selling the tools, the shovels. Today, the new digital gold rush has its clear shovel seller, NVIDIA. NVIDIA, which designs the most advanced chips needed to train AI models, is the single company consistently making vast profits, while most of the AI startups reliant on their products are burning cash heavily. NVIDIA has become the most valuable corporation on Earth, its market cap soaring on the hype of this frenzy. If you want to ride the AI wave, you must first pay the toll to the shovel seller. But the most critical warning sign of all is not the speculation itself, but the preparation for its inevitable crash. This AI boom is already being framed as a potential too big to fail 2.0. OpenAI's chief financial officer publicly called for a U.S. federal backstop for new chip investments, asking the government to act as the insurer of last resort to guarantee financing. Sam Altman, despite attempting to backtrack and claiming they weren't asking for a bailout, confirmed they have discussed loan guarantees as part of supporting semiconductor manufacturing in the U.S. A letter sent by OpenAI to the U.S. government explicitly called for government investments through loan guarantees and direct funding. This is the ultimate lesson of financial history. When the system becomes unstable, those at the top use their power to write new rules, ensuring they do not bear the cost. In 1929, the system collapsed under speculation. In 2008, banks were bailed out, and losses were socialized onto the taxpayer. Now Silicon Valley is preemptively demanding the same protection, making their massive speculative bets with the implicit guarantee of the state. The powerful learn that risk pays because someone else will always clean up the mess.
We are witnessing a historical phenomenon repeat itself. Every crisis begins with a breakthrough innovation, but ends in financial ruin because the story was too good and the leverage too high. The AI gold rush is fueled by the same cheap credit that propelled the 1929 stock crash.
It replicates the speculative mania of the dot-com era, where prices rose faster than any possible profits could justify. And it carries the moral hazard of every modern bailout, where the winners privatize their gains and the public is forced to absorb the risk. The economy we inhabit is engineered. It confuses credit with creation, consumption with culture, and speculation with progress. The entire global system depends on perpetual expansion, functioning structurally like a pyramid scheme, where old promises are paid with new credit and infinite new recruits. When this exponential growth model is applied to a highly expensive, unproven technology like AI, the resulting fragility is enormous. The only question is when, not if, this belief will collapse. History gives us 3 undeniable warning signs that a bubble is ready to pop. 1. When prices rise faster than comprehension. The rapid near $1 trillion valuation of loss-making AI startups clearly fits this pattern. 2. When experts say, "You don't understand the new paradigm." This is the mantra of every bull market, insisting that old rules like profitability and cash flow no longer apply. 3. When your friends start getting rich doing nothing. The promise of effortless riches is always the lure of the Ponzi scheme, now dressed in innovative ways like token schemes and guaranteed returns. When belief dies, the system trembles. You cannot stop credit creation, but you can move closer to real assets that survive when quality drains from the system. The hard truth is that bubbles don't die because of math. They die when reality runs out of believers. As the current AI frenzy demands ever more debt, ever more growth, and ever more government guarantees, the financial system ensures it rhymes with every disaster that came before. Real wealth is not found in promises of the system. It is found in assets that endure, in value that others depend on. Because when the dust settles, those are the people who still have their wealth and their freedom. You are not auditioning for a get-rich-quick scheme. You are auditioning for a history book. The choice is yours: to chase the illusion or to learn from the past and build something real.